This is Tom Aspray with the Viper Report Market Wrap video for the week ending April 4th. I'd be pretty confident that we're all glad this week is over. It was one of those two-day combinations that goes in the history books, as I'll show you in a table a little bit from now. The good news is that that table bodes well for stock prices in the next year and more. However, that's not any real consolation given the recent market action. So in my column today on Forbes, which is available now, I discuss the current market outlook and look particularly at the pivot levels on a yearly basis for next support levels. Clearly last week's 10% decline in a couple of days cut through most traditional levels of support, which of course is always an issue, just like a strong uptrend moves through all levels of resistance, leaving blue sky, or if on a decline, a dark hole ahead of you. The focus really on the article is also looking at past similar declines. 2018 was pretty ugly. We had some divergences in the NYSE daily AD line up in September 24th, I think it was. Sharp decline into the end of October, a pretty good rebound here, and we just chopped around until we had a waterfall decline in December. Bearish or bullish sentiment dropped below 20 here, as you can see down at about December 12th, and the AD lines got worse and worse. So the messages from this is actually somewhat encouraging. I think it was by about the 3rd of September, or 3rd of January, the AD lines closed positive, then the downtrend was broken, and then in February the AD line had already overcome the all-time high from the summer. This table is from Ryan Dietrich, Carson Investment Research, does some really nice data crunching. So you can see that the two-day moves, November of 2008, also in November of 2008, and then COVID 13.9, and then this year 10.5. After pretty much all those, 3 months for 2008 was a bit off, but 3 months was rather, but 6 months and 12 months were both higher. You can do this sort of analysis based on how extreme the bull minus the bear data is. Any number of different, not correlated indicators have reached extremes that we haven't really seen, some going back to the 1990s. The weekly chart of the SPY shows we closed well below the weekly Stark band and the daily Stark bands, with the yearly, and also we closed the week below the yearly pivot. So it was a lot of stuff happened. Yearly pivot was at 551 and change. So the S1 is not too far below we closed at 505.29 with the S1 at 497.81. The way last week went, that's a quick trade. More important support is really down in between in the 460 to 475 range, and it corresponds to the 2021 high before we had that decline that was pretty painful. I don't think we're going to see that sort of protracted decline. I think we got a lot of the pain out of the way very quickly. The S&P advanced decline line, you can see what prices have done. The AD line is just numerically right on its 20 week EMA, and still above the support here. The NYSE has dropped below it on the stocks only, but not on the all. Even if we get down to here, if we break decisively through it, that would create more of a serious top in the AD line. But that hasn't happened yet, so And you can see the AAI bull minus bear closed last week at minus 40. We saw that in 22, but really didn't see that in the bear market of 2007, 2008. For the Qs, the support here in the 400 area, which corresponds once again to that 2021 peak, and then drifts down to, say 375, which is the shoulder here of the early April, or the April peak, the first rebound in 22. And also some of the trading we saw, during the summer of 23. So, it's locked off lots of supply here. You can see, back here in COVID, it was pretty ugly too. It doesn't look so bad now, of course, because it, rebounded very quickly, and soon was making a new high. AD line here, also no divergences, and still above the early 2025 low. You look at the monthly AD lines based on the NYSE composite. It's still, the month's not over obviously, but it did make a new high in November with prices. It's declined, but still above its moving average. Very good support from 21, 22, and 23, above this line D. In terms of price, we're already getting there. So, the S1, we also crashed through the pivot. The S1 now at 16. The monthly chart of the NYSE composite shows that it's made it down to this first support level, around 17,600. Next, and that also corresponds to the high we have from 2021. Additional support here just below 17,000 in the S1 on a yearly basis, and then further down to 16,500. So that's not given we are up above 20,000, we're more near the lower end of that range. The uptrend here is also around 17,000. The monthly AD line, you can see way back in 2016, it's been positive throughout. Had a bunch of mixed signals in 22, 23, and then surged to the upside in early 24. So all this period in here is good support. Still above its moving average, and still positive. The NASDAQ composite has had quite a bit of the selling, 22.8% from the December 15th high. Closed last week below the S1 at 15,997. And, next support here, this line B, is around 16,000 or 14,646. The uptrend, from the late 22 and 23 lows has been broken this week. There are some surprises from the daily charts. You can see the Spider Trust here. We had a real good fake out on Wednesday as we got up and just reached the pivot and then reversed sharply to the downside as the tariff policy became a reality. I certainly wasn't expecting that really to happen. I thought it was another bluff, and we're hoping it is a bluff, but that'll be about the first sign, of some stabilization if he backs down on his plan. The surprising thing is the 80 line's back below its moving average and the prior low, but it's still above the low from March here and well above the stronger support that goes back to September, this line C. So, that's, it's, holding up so much better. You can see the trend of the AD line as opposed to the trend in price is quite a bit of difference. Bull bear at minus 40 and, an extreme oversold level. A few of the indicators we looked at last week that weren't that screamingly negative for stocks have changed around. One is the high-low relationship. It was a little more negative in the NASDAQ. You can see we had a little peak here that was fractionally above this peak, but that was around the 690, 700, 1400 on Friday. If you look at the New York Composite, similar sort of pattern, dwindling number of new highs, but up until Thursday and Friday, the number of new lows had not expanded. 1043, that's quite a large number. I guess the good news, if you can call it that, is that 1042, was not as bad as we saw a couple of times during 22, and of course well below the COVID low here, which looks to have been about 2600. Some of the extremes were on Thursday and Friday. Here's the data from the Wall Street Journal. You almost might want to take a screenshot of this. There were 252 advances, 2,585 declines. And you compare that to a total number of issues, at 2658. That's a pretty small ratio. Up to down volume, so there was 744 million up and 8 billion, 100,000 down. That was for Friday. Thursday wasn't much better, and you can see 362, over 2082, and the up to down volume levels were about the same, and new highs, went from 547 on Thursday to 1042. That level could hold for a while. Onto the watch list. No ETFs that aren't inverse other than the precious metals here. Though the IHF, that's incorrect, is positive based on the weekly DTS, and but all these the rest of these are inverse, I believe. SJB, it's a short high yield product, and FXC also, but pretty negative here. You can see that 0% of the growth are above their quarterly pivots, and 0% of the value are above there. So not a lot of green to play around with. Last week XLV was positive, but it's flipped back. Energy got hit hard late in the week, and so it, nobody above their quarterly pivots there either, and not, 8.3% have positive 3 days. Materials, Newmont Mining, Lockheed Martin in the industrial area. One that looks possibly the most interesting down the road here is Costco. It's gotten into some good support. But then if you look at McDonald's and TJ Maxx, are both kind of green. Still the auto parts, Orly and AZO. Consumer discretionary popped a little bit. You can see from this chart here, but I'm not convinced yet that's a bottom. The star is still consumer staples. It was the only sector, I believe, to be up in the last 6 months. And you got a bunch of, Coke, Dollar General, General Mills, and Clorox, 50% are weekly positive. That's pretty good given the rest of it. Healthcare, only 8.3% above their moving average. Financials also got smacked. The RS chart still looks pretty good, but Berkshire Hathaway, still got a green weekly, but it was also hit late in the day. Not much signs of life in this technology sector, though it's probably getting extended. You've been watching these videos since last summer. You remember that we saw a similar behavior, some sort of plunge in last July in the XLRE and the XLU before they turned the corner. Communications, a top or a period of consolidation. XLC did rebound on Friday, so we're watching it. Utilities are strong, and real estate is also strong. So those of you who use stock charts, you can see something, like this, where you can see, okay, well, these are the percentage up. And if you look at their candle glance charts, I'll take it to a little breakdown, and then you go down here, to price relative, and you're going to start to see some that have some pretty good. D Shorten had a nice move up, still in a downtrend, but the relative performance looks better than it does, for example, on Lululemon, which is just continues to drop. Nike, took a bid here. Lennar looking a little more possible, though you can see a huge range against on Friday. Had opened at 106.95, high of 115.89, a low of 106.20, and then closed at 103. So that's one thing I would be looking at to see some of these names, and also you can use this to look at the Dow components. Which one of those, if any, are starting to look better. Once again, with changes, and you look at the relative performance, that's a good way to try to separate some of these out. And so far, CRM Salesforce, is trying, but still, Home Depot, heavy volume on the downside. Goldman Sachs also. We have new earnings starting next week, and J.P. Morgan also. So pretty much all of these, for the most part, do look negative. Sherwin-Williams, maybe a housing play, looks a little bit better, but not many encouraging signs there. So what you'd like to see in terms of a bottom is look at that section I wrote on reversals on the Viper report. That's what we're looking for. So I'll be updating on Twitter during the week and early market action, so stay tuned. And I think this is not the end of the world, and probably as I said, I would not be surprised to see a number of those ETFs challenging the prior highs in the next month or two.